Welcome, FinTech Talkers, to another edition of the FinTech Talk Show. I'm your host, Patty. My guests today are two emerging fund managers, VCs shaping the future of FinTech and AI. Garnet Heraman of Aperture Venture Capital and Dave Anderson of Beat Ventures. Garnet is an investor and influencer with 25 years of experience at the intersection of AI, innovation, and inclusion. He's a frequent speaker at events around the world. From his LinkedIn profile, known for his logo diadly and levity, Mr. Heraman hails from a multiracial family in Trinidad and Tobago. His personal interests include meditation, animal welfare, fitness, food, wine, travel, art, design, and zombies. How do you work, Garnet? That's a long list of personal interests. We'll hopefully get to that. Dave, joining Garnet and me is Dave Anderson. He's the founding partner of Beat Ventures, an early-stage venture capital firm investing in companies that use AI to enhance humans in the overlooked legacy industries. He has been featured in Crane's Detroit Business 20 in their 20s, Huffington Post, Black Magazine, ABC's 2020. He has a Harvard MBA and a University of Michigan engineer. Welcome, Garnet and Dave, to the FinTech Talk Show.
Thanks for having us.
Hey, Patty, thanks for having us.
Thank you. Great. So before we dwell into the topics, do you want to give me a more fuller introduction, especially for the audience who don't know about you?
Dave
Garnet.
first.
Yeah, who wants to go first? Go.
Yeah, I'll hop in. I think that was a pretty good introduction, but I'm Dave Anderson. I am one half of Beat Ventures. So as you mentioned, Beat Ventures is a pre-seed and seed fund. We mainly do pre-seed, and we're focused on investing in companies that use AI to enhance, not replace humans, especially in overlooked legacy industries. Examples of those industries might include meat processing or oil and gas or accounting, which might be more relevant to this discussion. My background is as an engineer and entrepreneur prior to getting into VC. I started my career as an engineer in aerospace and defense and automotive. So I've built hardware and software products for these legacy industries and have an expertise in that space. And then I also launched my own company. I was the founder of a company in the prop tech space. And so I have a good mix of boots on the ground experience as an engineer, but then also I've started and helped to scale my own startups. So I feel like I can empathize with the founders that I'm investing in.
Awesome. Yeah, no, and it's called FinTech Talk, Dave, and but we talk broadly now. We talk about AI and how it impacts the knowledge industry, how it can impact entertainment and education. The meat and the oil and gas, we don't talk too much, but I think if we get time, we should get into that, because I'd love to learn about your perspective on how AI can kind of transform some of these kind of legacy industries. Garnet, over to you. Anything to add on the introduction?
On Dave's introduction, absolutely. I got stuff there. But I think this is a G-rated audience, right? So I think I'll just stick to my bio. So serial entrepreneur during the .com era. Well, I'm going to back up. So Columbia undergraduate, NYU MBA, graduate work at London School of Economics, and then got out into the real world and tried to make a living. Fell into entrepreneurship almost by accident, but right time, right place. Built 3 companies, 7 years, had 3 cash exits, set up my family office in 2007, and haven't run a company since. I've been investing as an angel, in the bad old days, Patty, we used to just call it a club fund, right? We had a club fund, which I think is most closely analogous to like a syndicate, maybe, I don't know, or like an angel syndicate, whatever. Did that for a while. Got involved with a number of the universities that I went to with their venture communities, and then started thinking a lot more about impact, right? So then that's kind of what led me to Aperture. My fund partner, William Crowder, brought me this thesis. I thought it was a great thesis. And we'll talk more about that. And so that's how we ended up with Aperture VC and launching in mid 21.
Gotcha. No, this is fascinating and very impressed, Garnet. I've known you for some time now, or not a whole lot, but I didn't know the full background. So you have you have great kind of background with Columbia and NYU.
Yeah, but I don't have that thing that Dave has, right? I always at a certain point in my career I started like coveting engineering experience, and I realized like as an investor, Dave, right? Like how hard we look for that. I mean, I don't know about you, but I look for it in all of my founders. So don't be too impressed because Dave has the trifecta, brother.
I think we both look up to each other. So,
Yeah. No, engineering's critical, but operating background and kind of angel investing, so learning the investment. So the startups in your portfolio probably get that full gamut of support. So we'll definitely get into that and talk more about it. Um, but let's get into some of the questions that I had for you. Um, and there's a commonly used word. Maybe I should define it as well when I use it. Emerging managers. So I think first time managers perhaps, or early, like first or second time, not kind of a part of a branded Silicon Valley firm, and usually not necessarily from a diverse, kind of underrepresented background. I think that's how I kind of define emerging managers.
It's
Maybe in Silicon
also
Valley or
it's also AUM sensitive. In my
yes,
a
yes,
lot
yes,
a
very
lot
good.
of LPs that we've talked to, historically, define it as Dave. I don't know what you heard, but like sub 100, um, pretty much anything sub 100, even if you're on fund three, it's still emerging in the eyes of the like major like capital allocators, right?
yeah,
Dave, yeah.
I think that's right. I've heard it defined as if you're on your first, second, or third fund, or you are just launching a new brand. But I try not to pay too much attention to the terminology. It's kind of like what actually defines a pre-seed round versus a seed round versus an A round. It's like I am what I am. I'm on fund one, and if you want to call me an emerging manager, that's fine with me.
Yeah. No, and yeah, the definitions can be broad. AUM is a great metric, but I kind of broaden it. Obviously first or second, and the diversity angle is interesting too, because I work with some minority founders, and as part of that, I've met a lot of minority managers, and they're growing in number. So it's interesting. The question around that is, you both being emerging managers, what are some of the opportunities and challenges for emerging managers, especially when you're competing with, say, the large branded firms in the Valley or elsewhere? Who wants to take that first?
Want me to go first this time?
Sure.
Opportunities and challenges. Let's see. So I think the challenge part is pretty obvious. Are you restricting this response to the valence of deal flow, or do you want like the general like hardship?
Yeah, no, broadly, yeah, I guess deal flow is one. Maybe if you kind of plot out, Garnet, the kind of the value chain of the VC, right? So
Sure.
deal flow is one. So if you can kind of address throughout.
So, I mean, the challenges start with capital formation, right? I mean, it's not an easy road to hoe. Getting to critical mass in a first fund, however you define that, it could be 15, 20, 30, 50, 75. None of that is easy to do as a diverse person or as a female, let's say. And so that's got to be a big one. Um, I'll just skip forward to the deal flow piece. For us, deal flow is a double-edged sword. We think about it as essentially the outcome of almost 40 years of investing experience between William and myself prior to Aperture, right? And so that's the opportunity. The fact that getting money into diverse founders is not really a function of actually, some investment thesis. It's a function of the GPs being diverse. And it's as simple as that. So the opportunity for us is going to places like Baltimore and, Milwaukee and Phoenix and wherever, where a lot of the Sand Hill Road gang, are not fishing and trying to fish in those waters, right? And it's a function of our own personal, social, cultural networks, right? I'm Indo-Caribbean, and so that's restricted enough, but on the other hand, it's not really a group of people that the Sand Hill Road boys are looking at, and they're actually starting to percolate up, right? In AI in particular. So, that's where the opportunity is to try to fish with founders where nobody else wants to fish with them, right? And on the other hand, the challenge is getting into the right types of syndicates and co-investment circles where we see the best possible deals, not only from the quality of the deal standpoint, but from the quality of the interest that we get, after we steward it to, like the next level. If I come in at seed, it'd be nice to know that Kleiner is waiting with open arms at Series A or Series B, right? But that's a challenge. It doesn't always work out that way.
Yeah. No, I think I was in a recent conference. I think Garnet, you were there too. The Latitude conference in San Diego, and I heard this in my panel. Somebody else said it, but I'm going to paraphrase or quote. Opportunities or talent is everywhere, but opportunity is not, right? And you kind of articulated that well, right? There might be talent everywhere, which is unrealized or hidden or not in the fishing kind of radar for kind of mainstream VCs. And that's kind of a huge unrealized potential for emerging managers like you. And you're kind of capitalizing on that. Yeah, there are some challenges on the capital formation and future rounds and all that you articulated, but just harvesting that kind of economic potential is huge. And thanks for kind of putting that, framing that. Dave, what do you think?
Yeah. I tend to focus way more on the opportunities than I do on the challenges. And maybe that's a symptom of me being overly optimistic most of the time. But on the opportunity side, I think the biggest opportunity we have as emerging managers, kind of hearkening to Garnet's point about fund size, is we're able to invest a lot earlier and still achieve the outcomes that will help to make our LPs happy. So because we're running relatively small funds, I can write a relatively small check in a pre-seed company that has an outsized return and get the DPI needed to produce some good results. And then I think the other big opportunity for us is getting our hands dirty. So we like to be pretty active when we write a check. Now, this is all dependent on how much help the entrepreneur or the founder says he or she wants. So we know when to get involved and when to step back and shut up. But assuming that they do want us involved, then we can get in and actually become a part of the team. And we have just enough resources between my partner Colin and I to do that. So I see that as a huge opportunity, not just to satisfy my own personal desire of wanting to be, a quasi founder and operate that way, but also to add value to the team and help them grow and scale.
Gotcha. So is that kind of more of a venture studio or a co-creation studio type model, or kind of more informal?
That's a great question. And I was actually just at a lunch earlier today talking about the pros and cons of venture studios. We are very much not a venture studio, but because I am meeting founders so early, in some cases before they even have an idea, I just meet a talented founder coming out of a big existing platform that wants to start some type of company, then I can work with them to whiteboard different ideas. And once they land on something that they really want to focus on and build, then help to construct the round and maybe even hire some team and help them find their first customers.
Yeah. So a couple of things, or maybe three things, right? So obviously the opportunity, the deal flow, sourcing deals that are not being sourced, right? That Garnet bought about. David, you articulate the returns, right? At the end of the day, it's returns, right? yeah, scale is important, but it's the return on whatever you're managing. And then this operating angle, which is very interesting because I do a little bit of that too with the startups that I invest in or support. So let's kind of maybe get into it, double click on each of them. On the deal sourcing, like the Baltimore example, it is challenging, Garnet, right? So how do you have your tentacles all over, identify that talent? What is that distribution network for the deal flow? How do you do it?
So we use the usual channels that I think a lot of good VCs use. William and I went to some fine schools. Like Dave went to some awesome schools. So we start there. Um, I'm a board member of the Columbia Venture Community. The Washington Square, which is the NYU Venture Group. Things like that. He does something similar at Duke. I think, if I'm not mistaken, he's actually teaching venture capital in the Duke Business School for the second year running. So things like that. We each come from something of an accelerator background. So William did work way back in the day with Dreamit before going to Comcast. So he has that whole network. Post Dreamit from YC and 500 and all that sort of stuff. I'm more familiar with the New York-based stuff. ERA and a handful of others. And I've been deliberately getting involved with more fintech focused things, Evo Nexus, the FIS, incubator, the ICBA incubator, that kind of stuff. So that, and then one thing that I'm doing is becoming an LP in other people's funds. So I'm an LP in a handful of funds, and I deliberately chose the funds to sort of help offset certain potential, they're not even really shortfalls, right? But they're potential shortfalls in our deal flow. So a specialty fund like an insurance company, like an insurtech fund, right? Neither William or I come from insurtech or insurance, so seemed like a good thing to do, right? And hopefully a good investment over time. So I think that's a somewhat novel strategy around deal flow and trying to capitalize. I love being able to be in. So the other thing is, as you know, Vadi, Berkeley Skydeck, right? I think the technically the world's biggest venture ecosystem, twice the size of the Stanford startup ecosystem, and also a prolific producer of like AI startups. So awesome, right in the sweet spot. So I've really enjoyed meeting the other GPs, and I think there's a bit of a flywheel there, right? Deal flow on the one side, and then GP like investment syndicate on the other side.
Right. No, that's great. David, anything on the deal flow before I get you on the returns?
Yeah, definitely. So I think a big theme of our fund is overlooked. Like we look for overlooked industries or overlooked opportunities in industries that are traditionally overlooked. That also means overlooked regions of the country or the world that others aren't necessarily looking at. I grew up in Detroit, and there's a ton of talent in places like Detroit all around the country that don't have access to the venture capital or resources that others do. I'm now based in San Francisco, and there's no dearth of of opportunity or access to capital here, but in Detroit, it's much different. And then there's of course overlooked founders. So that might mean there are diverse founders that don't have the same access to opportunity. And so we're trying to stick our hands in all of those overlooked buckets and identify the founders and the opportunities that have the biggest growth potential, and get involved at the early stage and write a check and grow with them.
Yeah, fascinating. No, it's great. Meaning, I think we should amplify what you're doing because I think not to talk about politics and all, but this comes into politics too in some ways. Maybe at the backside we can talk about the presidential elections and stuff like that. On the return side, right? So I hear you try to get in early and maybe that amplifies quite a bit, but there is that risk of when you're positions get diluted on later funding, and you say don't have a control as an emerging manager or a small fund to control some of that. So how do you manage that risk? Because I think that's kind of just not for you, David. It's probably a problem for all emerging or all small funds, right? Or like not big funds.
Yeah, I mean, it comes down to how we've modeled out our fund performance over time. And we can write a certain size check. We tend to be in the smaller side in that first round. So call it $100 to $300,000 check. And we're gonna own on average anywhere between like 1% to 3% of the company. And yeah, that's gonna be diluted over time. So there's a few different ways to think about that. You can protect your pro rata in future rounds and continue to invest in the seed and the A and the B. Or you could go after super pro rata and increase your ownership stake. But I've actually seen data that shows that that doesn't help your returns at the fund level. To be honest with you, like that's something that we're still figuring out because we're still relatively new in our fund life cycle. And now that our companies are starting to graduate, we are faced with the decision on, do we continue to invest? And so far that hasn't been a big part of our strategy, but that might change as we launch Fund 2 and 3.
Gotcha. And to Garnet, I think he alluded to, or he talked about how he has kind of relationships with other funds, or he's LPs into some other funds, or even relations with GPs who maybe invest in future rounds with him or without him.
Still hope to have a relationship with Beat Ventures, but they don't want anything to do with Aperture, apparently.
That is not true.
But David, are you kind of looking at that kind of model too? So almost like an ecosystem, right? So you are Beat Ventures, but then you have all these kind of side relationship, the stage and verticals and so on and so forth.
Totally, absolutely. We started a pretty popular event series here in the Bay Area, and we're going to be launching it elsewhere in the country called Investors Table. And it's been a quarterly gathering where we get roughly 100 VCs, senior level investors together for a very casual gathering. I think people are a little tired of the contrived events where you have to feel like you're networking. And we wanted to make it much more authentic and provide a way for VCs to just connect with each other. So this is something that myself, Sam from BMW iVentures, and Andrew from Shorewind Capital started during the pandemic, where we realized there was a ton of pent-up demand to get together again in person. And it started off around my dinner table, and then now it's grown to a very big event on a quarterly basis. Garnet came to the last one. We're going to be doing another one coming up soon. And yeah, like we definitely want those relationships with other investors so that we can not just share deal flow, but also share notes on industries and knowledge share, you know, what we're seeing coming down the pike. So that's one way that we're looking at it. I am not quite in the position to become a large LP in other funds yet. I have written an LP check in one fund as of to date, but that's definitely something that I'm looking at in the future.
No, gotcha. And on that,
Can I say something about Dave's event? I'm going to tell you, it was hands down the event that I felt the most comfortable, the most, like authentic goodwill vibe. And, both of you know me privately and how much I complain about having to socialize. And I can tell you, I truly enjoyed myself at Dave's event, which is like very rare.
Yeah. No, it sounds like great. I'd like to come, but there might be emerging managers listening to this too. Dave, is there, if they wanted to get in or get in, I'm thinking it's a kind of a private event, but how can they find out more, or should they just reach out to you on LinkedIn, or what's the best
I think
way?
reaching out to me on LinkedIn is good. It's become a little bigger than we were expecting it to become. So I don't have a website for it. You know, like we create a Luma every time we do it and we send it out. So if anyone wants to learn more, just reach out to me on LinkedIn and I'll send them the Luma invite.
Yeah, I might be aging myself. So Luma is I discovered Luma recently, meaning looks like it's a thing for events now, but I just recently discovered, and it's a nifty little thing. No, that's great. On the IRR or the returns, Garnet, you want to add something, or how do you kind of model that and manage that?
how do we model it? For fund one, it's kind of hard, right? Because all of the modeling is so prospective, right?
Yes.
Or it's even speculative.
Yeah.
Uh, we, I'm lucky because William managed Comcast Catalyst Fund, so he had a little bit of previous experience with the model building and also the fund admin side. So I can tell you the way we think about target ownership and maintaining that, and how we think about dilution and that kind of stuff. I always feel a little bit I don't know, ethereal talking about like returns, right? Obviously my goal is to return, as close to 10 or 20 or 50 times the fund as I possibly can. That's my goal. But so, that's sort of a top-down perspective. And I guess what I'm saying is I'm more comfortable with the bottom-up perspective. So let's look at that, right?
Okay.
So our target is in the 8 to 12% range, right? At the seeds and seed extension sort of level. Our target is to invest at least once. So we set aside in the portfolio modeling, I think 1.1, 1.2 to reinvest, X to reinvest. Um, that's the conceptual piece of it, right? Dave is he's probably at a similar stage in his portfolio development. I can tell you which companies I'm doubling and tripling down on right now
Yes.
because we've had 4 years to watch what's happening in some cases, and a little less than 4 years, 2 years, 2.5 years in others. But I can tell you where my and so what happens is you end up reallocating things that would have normally gone to some of these companies that are not performing, as well as you might want. And so you end up having a little bit more, hopefully, right? And so that's the reality of it. It's a little bit, for all this talk of modeling and targets and this kind of stuff, I think there's a little bit of empirical pragmatism that has to be applied, and a little bit of just common sense, right? You water the plants that are doing well, or you give more water to the plants that are doing really well, and maybe you give a little less water to some of these other plants, and that's just that's how you create the best possible bouquet, right? I don't know.
That's right. Yeah.
Wonky metaphor, but
Yeah, meaning you have limited water supply. That's the to use that.
it's like California in the 80s or something, like 90s.
Yeah. No, but that's good metaphor, a good analogy to look into it. And yeah, you can mathematically model it, but a lot of it is just kind of
Look,
practical.
all models are nothing more than white lines down the road, right? I mean, I believe there's both an art and a science to investing, right? So the science is whatever, right? These things that we're talking about, and what do they amount to? I believe the science amounts to essentially, white lines down the road. But why I really admire and respect and like working with someone like Dave is actually has more to do with the art of the right. It's his human authenticity. It's his level of discernment with other human beings, right? And that you have to find that, whether it's in a co-investor or whether it's in a founder that you invest in. You have to find that on your own. You can't. This is why a 22-year-old is never going to be a good investor, in my humble opinion,
Yeah,
right? What do you base discernment and nuance and decision making on if you have a relative dearth of life experience?
yeah.
I
So
don't know.
that's one school of thought or one philosophy, and the other is more just indexing, right? Like say YC, if I can use them as an
Sure.
example.
But that
They
only works at scale.
exactly, you need
That
scale.
the
Yeah,
indexing is the antithesis of, from a modeling standpoint, of the what you need to succeed as an emerging VC.
right. No, yeah. David, anything to add before we kind of move on to the operating and support of the
Yeah, feel free to throw some compliments my way, by the way.
They're coming, Garnet. No, to seriously though, to reciprocate, I think I enjoy working with emerging managers like Garnet because he's bringing a longer term experience than what I have, right? I mean, some of the relationships that he has, particularly in the banking industry, and in industries that he's built and sold companies in, that can't be replicated easily, especially by someone like myself. So I think that there's a symbiosis between my fund and his, where I know Garnett's going to hate me for saying this, but I might play poker with a founder early on and start to build a relationship, and bring the idea to a certain point, and then he can help get it over the goal line by introducing him to some of the customers that he has a decades-long relationship with. So I think we need each other.
We just had a great example, right? We just had a great example of how that would work. It hasn't gotten over the finish line yet, but we're working on a deal, Patty, where it's an amazing network that Dave tapped into to get this up on the radar. Amazing founder, great idea, hardcore AI, in a space that really not that many people have looked at yet. To Dave's thesis, and the coincidence happened, or the overlap, the alignment happened to be that, hey, they wanted to get to proof of concept with a couple of banks, right?
Mm-hmm.
I don't want to name them, right? We're not going to name the company, but yeah, and we came together on it really rapidly and started going down the rabbit hole, and we're still going down the rabbit hole on it. But it was a great example of how emerging managers, I think, can collaborate and sort of, amplify each other's strengths. And so for all my complaining, by the way, about the poker thing, I happen to think it's a genius way of like getting to some level of discernment, right? Of some level of like human understanding about who the hell are you dealing with, right? I mean, literally dealing with.
Yeah. No, I don't do too much poker, but looking at SF Tech Week, the agenda, I registered to a couple of pickle. I play a lot of pickleball, and looks like that's the in thing. There are like so many events in SF Tech Week, which is about investors meeting founders and that kind of stuff. So, but to your point, Garnett, like be it poker, be it pickleball, or be it any kind of that gathering that engages, right? I think that's critical than just kind of doing a pitch meeting and things like that. So I think you can assess quite a bit and form deeper kind of bonds.
If I could just add one thing to that, I think what we're getting at is building a level of trust in the founders that we're investing in. And trust is a factor of consistency over time. And so if I'm able to spend more time with a founder, then I can get to know how he or she thinks. And one way of doing that might be playing poker or pickleball, or golf, which is another thing that I like to do. But it's really just an excuse to spend a lot of time with that founder and understand them as people, rather than just a pitch meeting where you don't really gather that much information.
Very well put. Very well put.
I don't know if you've seen this, Dave, but based on that engagement strategy, there's an opportunity to Patty's line of questioning that comes out of it, in my opinion. And the opportunity by taking that human first or founder first, or, in level of engagement, is you open yourself up to this opportunity for asynchronous deal sourcing, right? So I know the founder as a human being. Yeah, I know he or she can play poker, play golf, play pickleball. I know who they are as a human being, and it may not be this deal or it may not be this idea, but either a future one or one of their buddies or something like that. I love the sort of randomness of the asynchronous deal sourcing, right?
Yeah. It's always, a network of networks. Yeah. No, totally. Meaning I love that. Meaning I think we didn't touch on this when we're kind of talking about differentiation, right? That the kind of upper tier or mainstream VC, I don't think that happens quite a bit. There's not that kind of personal bond, right? And I think the data or the numbers should show, right? Having that close connection, investor, founder, closer connection, closer working relationship would yield a better product for the founder, for the investor, and so on in the long run. But I like that. Moving on to the operating, I know David mentioned kind of roll up your sleeves, kind of help the companies in operations broadly, but how do you support, maybe go to you, Garnet, first. How do you support your portfolio companies and almost kind of make a pitch, right? For founders listening to my podcast, why should they reach out to you for their check?
So how does Aperture do it?
Aperture and you, yes.
Okay. So a little bit has to do with I think what Dave was getting at, which is just GP experience and having the kind of experience like that Dave sketched out, both operating as an entrepreneur, and then also having that technical founder, right, background of the engineering. We do a little bit of that. William's profile is a lot more like Dave's. Maybe a little less on the entrepreneurial side than Dave, but he has an actual degree in computer science, right? Like Dave in engineering. So we do those inputs individually, but what we are doing now is like a little bit more along the lines of portfolio services. So we have I don't know, 10 or 12 quote preferred consultants, preferred vendors who do mission critical things, starting with like recruiting, and all the way up to like fixing my deck, mundane stuff. We have relationship with a couple of these all-in-one like benefits providers like Insperity. Insperity is one of the sponsors of our annual general meeting in November in Atlanta. That kind of thing, right? So we try to like curate them and then make them really accessible to the portfolio companies on top of any individual like partner inputs and that kind of thing.
Yeah. And David, as I said, I do this a little bit. The challenge is scale with that, right? Meaning you are you, right? You have so many hours in the week and so on and so forth. So how do you solve for that, right? Say if your portfolio is growing and all of them need kind of that support. So how do you replicate? How do you clone yourself?
Yeah, I think this gets to Garnett's point about this being more of an art than a science. And this is an evolving process for us where we're just trying to refine and get better day by day. But our overarching philosophy is we know that most VCs add no value and some VCs add negative value. So our philosophy is first do no harm.
That's a Khosla quote.
That is. It's a derivation of Khosla's quote. And so like we want to first do no harm, right? And only talk to the things that we know something about. And as VCs currently in our career, where we know the most about is fundraising. So we know we can be helpful on the fundraising front because our job is basically to chit chat with other VCs, right? That's a big part of our job. So we have a good network and we can help fundraise. But then it has to do way more with the emotional side of being a founder. So having been in their shoes before, I know how much of an emotional roller coaster being a founder can be. So sometimes that just means having someone you can text when you've had a big win or had a big loss. And so a lot of VCs say, we want to be your first call. We truly mean it. And I can show you my text messages just from today that I got both good and bad from founders that either closed their first customer or had a big loss on the team or whatever it is, right? But that's what my texts look like on a daily basis. Yeah. And then there are things that are a little bit more tangible where, after listening, and I think that's really important, is just to listen to the needs of whatever that founder is bringing to the table. We might try to help guide them to product market fit by going through some of the canned exercises that we've done many times through our career, or help them find that first customer, help them find those first hires. But that all starts with listening to what their needs are and responding accordingly.
Yeah. No, it seems main to use the phrase high tech and high touch, right? So emerging managers, just to summarize our discussion here, it's a lot about high tech in terms of support, technology, and fundraising and other things. but also high touch, right? Playing poker, playing pickleball, getting to know each other, understanding. I think that's the benefit or the biggest opportunity. And I can hear you both when you talk about it, right? You're passionate about it. You kind of almost enjoy this. This is kind of naturally coming for you. So I think for folks who want to become an emerging manager, this can be inspiring, right? This might be the step they take, or this when they listen to you, they might take that step to go raise some money and become an emerging manager and kind of build that family. It's almost like an extended family for you. The company.
I have a project. I have a mantle for you to take up, Patty,
Sure.
based on Dave's excellent suggestion. Dave used that Khosla quote, and it's, it's shockingly true, right? And it made me think of, these certain industries that actually have, like a credo, right? Or an oath. So, and I couldn't remember. That's what I was just fiddling my phone for. So we need, isn't it shocking that VC doesn't have the equivalent of a Hippocratic oath? We have a hypocritical oath, right? People promise shit and then they don't do it, and potentially do harm, which is Dave's point and Mr. Kosla's point. But here's the mantle for you to take up, Patty. You need to write the VC Hippocratic oath, brother.
I will do that as part of this summary. So, but that's a great point. Do no harm, right? If you can't help, if you don't have expertise, that's a great point. And I think investors are just worried about their thing, and they sometimes get into that. So I can see that perspective too. But that's a great suggestion. I'll take that up, Garnet. I want to switch gears a little bit. We kind of talked about the process, the kind of the role, the opportunity of the emerging managers. Now I want to get into kind of what you invest in, your thesis, kind of vis-a-vis the trends in the industry. Obviously, it's 2024. It's not 2023, but it's still AI everywhere. The show is fintech. Obviously, fintech's taken a little bit of back burner, but I write about some trends and stuff. So a couple of things, if I can kick off this thread on the biggest opportunities in AI that I see is kind of the knowledge economy or the knowledge worker disintermediation, right? So AI or copilots or agents or what have you can take on what a programmer, what a software developer, what a tax preparer, what an accountant, what a CFO. The list goes on, right? The Mino was a good example. I think the guy who started Tinder, he started this company called Mino, which is a AI-based relationship advisor for kind of dating and that kind of stuff. And he raised a ton of money because obviously he had a big success. So there's no so knowledge worker and knowledge economy, I mean it very broadly, right? Any human kind of job can be taken. So I call it AI-berization, but other folks call it differently. That I see as a big bundle of opportunity, and agentic and all those fit into that, right? And we're still early in the thing. The other, I like to call it hyper-personalization at scale. The best is the Genflix example I take. So Netflix now kind of takes a lot of stuff we watch, which one we watch, which one we liked, and then recommends, okay, you like this. Tomorrow's Genflix, which is not yet there, will also kind of learn from what your preferences are, but it won't recommend a pre-made show. It'll kind of generate a show for you on the fly, so to speak, with the plot and with the actors and so on and so forth. And that's what I mean by hyper-personalization at scale. That applies to marketing, that applies to entertainment, maybe education, personalized tutoring, and also election campaigns, persuasion, that kind of stuff, right? So that's the big. And then, of course, defense, autonomous warfare, the whole when there's a gold rush, you sell more shells and picks, right? So Nvidia is $1 trillion company, so infrastructure will always be there, and things like pharma, drug discovery, that are companies that will raise billions of dollars. But I rattle a lot of examples. I want to hear from you. Where do you think the biggest trend is, and vis-a-vis your investment thesis? So you can start with your investment thesis and kind of talk about the trends, or vice versa. Who wants to go first?
I'm happy to kick it off, Garnet.
Dave's the expert, so.
Yeah, I think you touched on a lot there. So I'll start with our thesis. So Beat Ventures, we invest in pre-seed and seed companies that enhance, not replace humans, especially in overlooked legacy industries. So I said that at the outset, reiterating it now. And there's a good reason that we came to this thesis. So I'll separate it into two categories. I'll separate myself into two categories. The first is like the inner child, lover of sci-fi, lover of tech, the techno optimist in me. And then the second half is the pragmatist, based on the experience that I've had as an engineer. And the techno optimist side of me wants to see AGI, achieve its full potential. Definitely have humans be able to focus on creativity and judgment and the things that make humans unique while completely automating everything else. And however, the pragmatist, based on my experience side of me, understands that there are many, many challenges to achieving that future. And we've seen it play out. I think a good analogy to speak about here is in the autonomous driving world. And so we have two companies, Waymo and Uber, that were started at effectively the same time in 2009, I believe. And we've seen the trajectory of those two companies over the last 15 years. And Waymo has taken 15 years, and I think they're a fantastic company. I know I have friends that work at Waymo, and they are trying to fully automate the driving stack.
Mm-hmm.
Yet they're only operational in, I believe, 3 cities in the world, and they're producing relatively little revenue. Now, when you compare that to Uber, that was also started in 2009, they started producing revenue right away, and they were not reliant on self-driving technology. And so I say, like, the Waymo is the techno-optimist side, and Uber is the more pragmatic side. Mm-hmm. And so, like, I have to balance that as an investor when it comes to my thesis. So what do I feel is going to present the biggest opportunity today in 2024 that's going to provide the best returns for my LPs? So that's kind of the lens in which I view opportunities. And that's what led us to focus on these overlooked industries where you're not trying to fully replace the human. Instead, you're trying to enhance humans to do their jobs better. So I know I've spoken a lot there. I'm happy to keep going.
That's wonderful. Keep going, and it's beautiful and well put. And that Uber Waymo thing was excellent, meaning that captures kind of the essence. I mean, there's something to be said about moonshot, right? Elon Musk wants to send people to Mars and things like that. There's a time and a place for it in some ways, right? But yeah, your thing is to return to your LPs, right? And you're laser focused on that. That's a great way to kind of have that lens. But keep going.
Okay. So the other big part of our thesis that I'll dive into a little bit is the overlooked industries piece. So as I mentioned, I grew up in Detroit, where automotive and manufacturing is core to the heartbeat of Detroit. And my partner grew up in Raleigh, North Carolina, where there's a lot of similarities in the industries that drive these areas. And so we built our careers in these overlooked industries where, on the one hand, it seems ripe for disruption, for automation to, absolutely tear through the economies and put a lot of people out of work. However, due to the complexity of a lot of these industries, it's not going to be as easy to automate the human completely out of the loop. And so we think there's a huge opportunity to invest in companies that are targeting these overlooked industries, also driven by the fact that the OpenAIs of the world, the big LLM foundation model developers, are very unlikely to ever move into the application layer that focuses on these overlooked industries. So we think that leaves open the opportunity for an entrepreneur who has an expertise, that has direct experience in building in meat processing or oil and gas or accounting or manufacturing, and the list goes on, to build a company that leverages AI and gets to revenue very quickly, and produces, I'll call it a $5 to $10 billion outcome, which is relatively tying back in the returns. It's a great outcome for us as a pre-seed firm to provide returns to our LPs.
Gotcha. No, wonderful. I had a previous podcast a couple of weeks ago, maybe, and there was kind of a similar theme around verticalization. That was kind of more fintech, but even fintech's getting hyper verticalized, right? Like what you talk about, meat packing, but small business, but like the pizza delivery, right? How do you incorporate there, integrate, or put embedded finance there? So no, wonderful. I can see, and that's almost like that, going back to the red ocean, blue ocean, right? So that's kind of your blue ocean strategy, which is pretty neat in many ways. Garnet, given the fintech kind of expertise you have and the background you have and your investments, talk a little bit about that intersection with AI and especially Gen AI. I know you have some companies that kind of make things easy with that too.
Yeah, actually, I'm going to talk less about Gen AI and more about sort of a flavor of what Dave's large, his macro thesis, because his macro thesis is definitely one of ours. I have a kind of a portfolio of like sub theses, and then I kind of try to look for the triangulation. I look for the intersection between that macro and then some of these sub theses. So one of them that very much relates to Dave's macro thesis, but is a little bit more granular for fintech in particular, is around this notion of finding critical problems in the infrastructure of FIs, financial institutions, larger ones in particular. And where we settled on when we sort of followed that logic chain was compliance. And if you do something wrong and you're a bank, it's not a small problem, right? The fines associated with it are, they start at 8 figures and then they go to 9 figures. And if you get enough of those 9-figure fines, it's a 10-figure problem, right? So, and as we were working backwards from that pain point around compliance, we started thinking a lot about AI and where AI fits. But again, back to Dave's macro thesis, which I think is an excellent one. There were challenges around applying AI across the entire workflow that needed to be addressed. So there was a definite need for the human in the loop piece. And, when you put all this together, it what comes out the other end is Azimuth, our AI compliance company, right?
Uh-huh.
Which Patty knows a little bit about. And, Patty was gracious enough to share with some of his investor network. And so, what I try to do is very similar to Dave as a starting point, and then I try to have like a portfolio of these sub theses, and then look for the intersection, the sort of Venn diagram sweet spot between the macro and the more micro theses, sub theses. So, where that's leading me is to different places. This is again, I can't tell you how much I respect Dave's macro thesis. So I'm looking at agentic for a blue ocean space. Where the humans will never be out of the loop completely, but it's like on a legacy basis, completely under technologized. So I'm looking at agentic AI for home supply contractor supplies kind of thing, right? That's if it's the perfect match of the macro thesis with this very specific sub thesis that's very vertical. And then add to that the fragmentation that you see in the distributor and the contractor space for home supplies, home improvement supplies.
Yeah.
So things like that lead me to have a very, I don't know what to call it, Dave, like target, like goal oriented type. I have a handful of these theses that I go out into the marketplace and look and like aggressively look for. So the deal that Dave and I were working on, fits into this frame where, if you go back and you think about it in the context of Azimuth, that deal, so the value proposition for the deal that Dave and I were looking at was that this does like model validation from a compliance standpoint. As you develop more and more internal AI models, there's a whole bunch of compliance issues, right? Fair lending, all sorts of things that need to be tested in each generation of the model. And this was picks and shovels for that. So I was like, oh my God, that's perfect. That's never going to go away. And it's a serious pain point for big FIs, you know.
Yeah. Yeah. No, I think I've seen a lot of sales tech or sales automation, sales AI, but the compliance angle is interesting because that is a cost, right? So if there's efficiency and a lot of efficiency potential in it, it totally makes sense. And yes, Azimuth is a great example of that. I think you brought up, and I think we need to run to closing too, but real quickly, maybe 30 seconds each, on the human in the loop versus the utopian agentic, right? Where there's no human, AI is doing everything. It's kind of figuring out what the problem is, talking to different LLMs, SLMs, and things like that. So both of you kind of tended to go with the human in the loop angle. But what do you think? Meaning, is that a transitionary phase? Would we see kind of less and less and more automation, less and less human in the loop, or human in the loop will always be there?
I'm going to defer to Dave on this one because I can only tell you where I think we're going to make money in the next 5 years.
I mean, in many ways, this is the holy grail question to answer, right?
Yeah.
And I've thought a lot about this, and I think where I currently am is that it will eventually happen, AGI or whatever, full automation, whatever you want to call it. But the biggest question is, over what time scale will it happen? Because there are very few assumptions that you have to include in order to assume that to arrive at the conclusion that AGI will happen, right? All that has to happen is that the AI that we currently have gets better and better, right?
Yeah.
And if it continues to get better and better, then it might take 1,000 years, it might take 100 years, but we will eventually get there. But I think we are in a transitionary phase today where the human is going to be in the loop for a very long time. And when I look at and talk to a lot of the experts that know much more about AI in this industry than I do, they tend to agree. And these are the people that are building the models, and again, have a much deeper expertise than I do. So, I tend to disregard the headlines that AGI is right around the corner and rely on the fact that I think AGI is at least 40 to 60 years away, perhaps.
Yeah. No, I did a show on AGI actually some time back, and we had similar discussions and kind of all flavors of it, right? So we have a lot of language control in LLMs, right? But it's not kind of, reality is more than just language, right? Or knowledge is more than just language. There's physics and other things, and then eventually quantum. So some theorize, and I kind of have written about this too, that eventually you need to get into those other physical dimensions and stuff like that, right? Take an image in pixel and analyzing it as one level of intelligence, but being actually in the physics of it, so to speak, right, is different. But I go that.
Can I add an end cap, because I think it's like a perfect sort of glib summary of why what Dave was saying is going to be absolutely true. The other day I was at an event, and a gray hair like myself, was up on stage, and she said something I thought was very like mic drop. It was like, she said, it's very easy to predict technological innovation, where directionally where it's headed. It's very hard to predict human behavior and acceptance of said technological innovation. And I was like, holy shit, that's like the history of my entire career from the late 90s till now, is seeing these awesome ideas that the techno optimist science fiction lover in me would love to see happen, and then like having to wait 20 years for it to like actually happen, right?
Yeah. Oh, that's great. Thanks. That's excellent. And I almost tie it to what.
Thank that lady.
Almost tied to what Dave said about pragmatism versus utopian kind of view, right? For a technologist, maybe some of the founders too, right? They need just not the technology, but kind of sociology or history and kind of more the humanities, right? To understand human behavior and changes and things like that. But we can go on. I think we should do a show on AGI or agentic or the future of AI kind of separately. We've been talking, this not been feeling, but it's almost an hour. So why don't we get to close? So in closing, and whoever wants to go first, where can folks find you, right? What's the best social media, or if you want to give out your email too, if startups looking to kind of connect with you and things like that. And who are you looking to connect? I'm thinking startups for deal flow, but others. And any predictions you want to make, including the upcoming less than 30, 40 days of the US presidential elections. So it doesn't have to be just about the election. You can make any prediction. So who wants to go first on closing?
I'll go, whatever. Happy to give out my email. One of the things that Aperture prides itself on is accessibility, and in particular to folks who are typically not given access historically, right? Folks of color and women. It's just my first name at aperturevc.com.
Okay.
Website is aperturevc.com. I'm accessible on LinkedIn. Whenever I'm in San Francisco, if you just stalk Patty, I'm probably not far behind. Or if you stalk Dave, I'm probably not far behind. You can find us drinking at Sprezzatura from with some frequency. And I'm looking for great fintech AI founders. I'm looking for copacetic co-investors, folks that have a similar worldview, similar set of expectations. Yeah, that's it.
Great. Thank you, Garnet. Dave?
Yeah. Also accessible in many of the same areas that Garnet mentioned. My email inbox is a mess. But my email is dave@beatventures.com. It's probably better to reach out on LinkedIn. If you search Dave Anderson and put Beat Ventures behind it, you'll find me. And our website is beatventures.com. So we can be found on any of those. On Twitter, I'm Mr. Dave Allen, which is my middle name. Not super active, but I do tend to amplify things that my portfolio companies are doing. And then you mentioned predictions for the future.
Yeah.
And I tend to stay away from making predictions because it hasn't been great for me in the past. However, I will say that what I'm looking forward to post-election is more certainty, because I think what markets hate more than anything is uncertainty. And right now it feels so uncertain. So I'm just looking forward to being able to plan a little further in advance, because we know what the environment's going to look like post-election.
Gotcha. Garnet, anything on the predictions before we wrap up?
Yeah, absolutely. I'm gonna buy more double-breasted blazers because I'm kind of having a moment. My prediction. Well, the rest of it is a little bit too ethereal, a little bit too speculative for me.
That shall be the last word. Thank you, Garnet and Dave, for being on the FinTech Talk Show.
Thank you so much, Patty. This was so much fun. I told you it'd be fun with Dave and me, right?
Yes.
Thanks so much, Patty. Yeah, this is a lot of fun.